Even in an AI-focused world, MacroEdge is in the business of focusing on you. We don't just understand our clients, we listen to what's said and illuminate on what's not. In a world moving at the speed of light, with shifting markets, evolving workforces, and non-stop disruption, MacroEdge helps you to navigate and identify novel opportunities, expand your enterprise, and succeed in tomorrow's world. And it all starts with you. Put your enterprise and your perspective in the driver's seat. We're in the business of you.
Yes. Welcome back, everyone. Welcome back to an era wherein I never thought I'd live to see it again in my lifetime. This is John Galt speaking. Welcome to MacroEdge Radio on Friday, August 22nd, 2025, where if the host would allow me and my co-hosts would allow me, I will play nothing but 1970s disco dance music and the Welcome Back Kotter theme to remind you of what I lived through in my high school and early college years, because now we get to share that with Generation Z and Generation X and Generation Millennial, and they get to enjoy everything I struggled through. More on that in one moment. Tonight, I wish to sit there and make a huge announcement to start the program. MacroEdge Radio is now available on Apple. Thank God we have that podcast going, because that's a huge, huge help for everybody. It is one of the bigger developments, but we're also now available on Spotify, which I personally think is a lot larger. People are married to the Apple platform, and I totally get that. I totally understand that. You've spent the money, you're going to sit there and invest in that. You're going to stay on that platform, but now we're available a bunch more platforms. Of course, YouTube. The most recent interview with Danielle DiMartino Booth, which was a huge smashing hit, and she pretty much nailed the forecast, but we really, honest to God speaking, I don't think any of us thought that Powell would act like he's folding as he has done today. What am I talking about? Unless you've been living under a rock for the last 12 hours. This morning, Federal Reserve Chairman Jay Powell, looking haggard as he got off the plane yesterday in Wyoming, gave a speech where I'm just going to read two paragraphs from his speech directly from the Federal Reserve web pages. Quote, turning to inflation, higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data indicate that total PCE prices rose 2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9% above their level a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. Now, I'm going to pause right there and say, nonsense. A modest decline in the methodology used to measure good prices in 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a bit above what has historically been consistent with 2% inflation. We'll pause again and just offer a John Galt commentary. Housing inflation has been changed since the 1980s. We don't measure it based on here's the basket of prices at a national average, and here's the basket of rental prices at a national average. We concocted a formula to try and make a hybrid of the two so we could smooth it over and take advantage of lower prices in either basket to keep the rate of inflation artificially low for decades. And that worked great until the crash in 2007, 2008. I continue. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about timing and amounts. The questions that matter for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through the supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. We'll end that part of the discussion right now and simply sit there and point out some things that Mr. Powell didn't want to talk about, but that Mr. Powell probably should discuss. And that is that here we go again, trying to sit there and say that this is a one-time shock. Now, I truly believe this is a one-time shock. However, President Trump and his administration have turned this into an evolving rolling shock. Most people see a tsunami, 15-foot wave heads towards the shore, wipes out everything in its path, recedes, you rebuild. What's unique about this tariff situation is we had another release tonight after the market closes conveniently of a quote-unquote investigation of foreign furniture manufacturers to subject them to higher tariff requirements due to the alleged bias against American furniture manufacturers by artificial subsidies introduced overseas. There's only one problem with this. That horse left the barn already. The majority of furniture is now made in Southeast Asia, China, and other countries. We do have a furniture industry in North Carolina and South Carolina, primarily North Carolina, and some other states. It's an extremely expensive proposition to purchase furniture from those states. And now, with all of the other craziness that's going on, you will notice pretty quickly that a tariff on furniture in the next 50 days plus will result in higher prices, once again impacting the consumer who is required to finance their purchases. So this isn't going to affect the ultra wealthy who can walk into a wood shop or an upholsterer or a custom furniture shop and order something designed for their homes. However, Joe Schlub and his wife, who have a net household income of $63,000 per year, no kids at this time, starter household, no home, still living in an apartment hoping to own a house, now have to finance this furniture. Well, if the price of that furniture drops 20%, please explain to me why they're going to purchase it, how they're going to purchase it. What do you call that? We call that inflation. It's a direct impact that hits the middle class and the lowest tier or the lowest caste in American society the hardest. Sorry, I had to mute while I took a sip there because this rant is not over. The problem we're about to witness and the problem that is being mismeasured by the administration, and I will say this one more time, is that we are beginning to see the outcomes of these decisions. These decisions are going to impact not who the administration thinks it will impact. It doesn't impact the nations that are exporting at all, except for reduced orders. But the theory is, based on the market rally today, we'll get to the market data in a minute, is that there's going to be a 25 basis point cut at the September 16th, 17th FOMC meeting. And it's going to be called a maintenance cut or an adjustment to compensate for the new unemployment data, which is insane since the unemployment data that was reported and revised lower will be re-revised under the new formula from a guy who wrote some of the worst college papers I'd ever read. And I used to think E.J. Antoni was brilliant until someone provided a link to some of his papers. And I said, oh my God, we hired this guy to run everything. So this isn't about interest rates, because 25 basis points is like a little boy walking up on the beach, pissing into the ocean to say it needs some water because the tide's receding. This isn't about interest rates nor the lowering of interest rates, despite everything we heard sprayed today from the administration. In fact, Trump went on a rampage saying that Powell's too late and he can't cut enough. This is about access to credit for the lowest 50th percentile of the American public. And the American public who is in that lower caste, and that 50th percentile includes two groups of people primarily. The lowest 30%, aka the perpetually poor. There's always going to be 20 to 30% of the American public which will be in that lower caste, either through choice, ability, willingness to escape the government plantation, or just bad luck and unskilled labor capabilities that can only achieve a certain level. Nothing wrong with that. Hard work deserves rewards, but you can only go so far with that in a career, especially in a society with an inflationary high-tech evolution underway. Then there's another 20%. Those are the poor souls who were told and believed the garbage that Franklin Delano Roosevelt, the Democrat Party, and the Republican Party sold them, that you can live off Social Security. Don't worry about investing your money. Don't worry about saving money. Hey, everything will be awesome. And that 20% is the one who's cutting your bologna at Publix at the deli or bagging your groceries at a local Ingles grocery store in North Carolina. You have individuals who are having to work until they're 80 years old now, sometimes older, simply to make ends meet, to put a meal on the table and feed Fluffy the cat. But we don't want to talk about that. We don't want to talk about that 20%. They don't exist because theoretically, in the government statistician's mind, they're going to die off soon and we'll be rid of them. In the economist on Wall Street's mind, they have no purchasing power. So who gives a shit about them? Who cares if they pass away? Who cares if they die? We don't care about that 20%. They're considered useless eaters in a communist society. In our society, they're considered, hey, wow, that's somebody's mom and dad. Who cares? That's the way we view those people. The inability to access credit is going to be the biggest issue facing the Trump administration in the next 12 to 18 months, and it may well cost them the next election. We have 12 plus years of excessive waste and government spending. And we have always had this belief that we can buy our debt, monetize our debt, or force the world to buy our debt and monetize our debt because we're the world's reserve currency. Well, the world is changing too, and they've gotten wise to this game. A lot of individuals I talk to, especially online, because that's the best way to communicate nowadays. Granted, it's social media. X has one thing that goes very hard and very strong. You're allowed to communicate with people around the world that you normally would not meet unless you deal with them in business on a daily basis. And when you talk to them and you talk about things that are happening overseas, you find out things. A lot of people are not aware that China and India have been having ongoing high-level meetings, and the re-emergence of the concept of Chindia, a Chinese-India economic cooperation pact, is arising. There's some issues militarily. India is building improved roads into the Himalayas so they don't get surprised like they did in the 60s. China has bolstered their border also. Both sides are going to try and talk themselves down from that level. It's not like there's a lot of population in that region, but they probably could come up to some sort of neutral zone agreement and peace agreement, because what they're seeing is, and in India really is frustrated and angry right now with the Trump administration for what happened to them. The backlash from that is going to be severe. So this belief that you can no longer fail in life or business, that the government will always bail you out as an individual or an institution or as a home builder or as a mortgage underwriter or an insurance company, is why we've reached reckless levels of gambling, not just on Wall Street, but in our society as a whole. This week we have Robinhood and the CME offering gambling on sports. Only way to phrase it. Now, how is that legal? Well, it's actually futures on sports events outcomes. So you're not technically betting over-unders, point spreads, quarterback yardage over-unders. You're betting on outcomes. So there's going to be 12 games on Sunday. I'm going to bet on the outcome that 7 of them will be from this group or whatever. I don't know how it's going to work. It's asinine. We're letting our commodity trading pits and online casinos known as investment houses online, for lack of a better phrase, to become casinos, to become online gambling sites because they need to raise cash. A lot of people don't know this about Robinhood. A lot of people don't know this about any of the smaller online brokerages, whether it's E-Trade or any of the rest. Their number one goal is not commissions. Their number one goal, they couldn't give a crap what you buy, what you sell. They couldn't care about your account because you probably don't have 9 figures in it. And if you did have 9 figures in an E-Trade or Robinhood account, you probably should be in a rubber room somewhere, bouncing off the walls, praying to God they give you that Thorazine shot so your brain can go back into la la land, or maybe snort some fentanyl off the rubber. I can't even describe the insanity of thinking about that. But they want your data. And there was a story this week about it, how they're front running the data. They're collecting from you and in microseconds, relaying it to the larger trading houses. And oh yeah, if you haven't been paying attention to MacroEdge Radio or JohnGaltFLA.com or MacroEdge.net or many other websites in this story, 63% of all trading is in dark pools off the main markets that you see online every day as the casino. They're private trades through private entities, and you have no idea what the volume is, the bidder ask, nothing until it rolls into the public arena. If I have 5 microseconds on your trade, I can front run your trade with my computer, and I can make you pay more or sell for less. Let that sink in on a day like today, where 9.6 billion shares were traded on the NASDAQ, 5.1 billion on the New York Stock Exchange. Dow up 846 to 45,631, and I'm rounding all the numbers off, boys and girls. S&P 500 up 96 to 6466. NASDAQ up 396 to 21,496. I will give you my one and only prediction on this. The VIX is dead until September. 6,500 is a given on the S&P 500 with NVIDIA reporting next week. 22,000 also on the NASDAQ. I think they'll get that nice and safe. Probably see 46,000 or a little bit over that on the Dow, by the way. Crude oil is dead money walking up 44 cents for the WTI to 63.66. Brent up 6 cents to 67.73. Both, once again, indicating a slowing in the economy, but who cares about that? We're all about to get government credit cards at some point, right? Gold, however, reflected the accurate assessment of Powell's speech. You have our friend, Mr. Gold, up 37 bucks to 34.18. Silver up 97 cents to 39.05. Both look like they're poised to break out because there's no reason to doubt. We will print, we will go off the deep end, and we will sit there and make sure there's plenty of money. And the most important commodity quotes of them all, because it directly affects your ability to enjoy fast food and or meat at home. Feeder cattle up 465 to 362.68. Live cattle up $1.30 to 239.95. Both all-time highs in the history of those markets. I wrote about that earlier this week. I simply warn you, you ain't seen nothing yet. The 2-year down 9 bips today to 33.698. The 10-year up minus 7 bips to 4.256. 2s, 10s up 2 ticks to 0.56%. 10-year 3-month down 3 bases to 0.06%. The interesting trade for me, and the one I'm telling everyone right now to watch, is the T-bills. The 1-month bill was up 2.1 bips to 4.351, and that is going to be the big banana. Foreigners are going to buy T-bills. Why? Because you can't trust the long end of the curve with the circus show we have in Washington, D.C. right now. Next, and last but not least, and this is a big one, we have the most active stock on the NASDAQ. Most people have never heard of Motive Medical, M-O-D-I-V. Motive Care is the actual name of it, I should say. It was up 91.07 cents today to close at $1.07, up 51 whole cents. To give you some idea of the gambling mentality on Wall Street, this is a NASDAQ traded, most active NASDAQ traded stock with 299 million shares traded. It is a Chapter 11 filing 2 days ago. After the market closed today at 5 o'clock, they got their NASDAQ delisting notice. In the transportation news side of things that I'm just keeping an eye on in the back corner of my mind for everybody to pay attention, Port of Los Angeles, Long Beach, it started weakening. August 31st through September 6th, we're looking at a 30% decline in week over week containers arrival. Now, granted, there's Labor Day involved in that. But year over year, it's not as strong as you think. According to Peers S&P Global data, total inbound containers to the United States on TEU is how we measure that, is only at 5.4%. So if the economy is so strong, why are our imports not so strong? Oh, they're bringing it in through Mexico. Transportation from the United States Department of Transportation, Bureau of Transportation Statistics. July truck crossings from Mexico into the U.S. up a whole 0.3% year over year. I don't see that surge, and neither should you. Meanwhile, the strong consumer allegedly, which I've been writing about, screeching about, and bitching about, is about to take it in the shorts once again. But I want to bring one of our guests on from the team, from the MacroEdge team, Mr. Ulysses Awsumb, because at this point in time, it's hard to not talk about what happens to interest rates when you think about what the United Kingdom did, cutting central bank, the Bank of England, cutting interest rates, but their long-term rates and yields rose. Ulysses, welcome back to MacroEdge Radio.
Thanks, John. Pleasure to be here. How you doing?
I got my blood pressure back down.
That's good.
Well, I honestly think people don't understand that does nothing about the problem with real estate. And we'll take residential first, the affordability issue. Have at it, sir, because I don't think people understand the concept of affordability.
Yeah, I think there's a lot of discussion about that term affordability right now, and a lot of it revolves around the idea of rates, especially with the expectation of the Federal Reserve cutting rates, albeit misguidedly. But there's not a lot of discussion around price. But both of those items are imperative to make affordability an unnecessary or functional piece for people to continue to buy homes. We're on pace for 3.8 million sales of existing homes this year. And while new home builders have done a fairly good job incentivizing through rate buy downs, even their sales have been troublesome, and they're beginning to feel the carry costs of those rate buy downs of negative pricing power. So affordability really is a combination of what is the price of a thing and what is the rate of the money that you pay for that thing. It's not limited to one. It's a union, and part of that is because of how our mortgages work. People borrow money in order to buy a home. So they not only have to borrow the sales price, but they have to be able to afford the payment that goes with it. And that's based on obviously both the price and the interest rate. To your point about interest rates, we had a 50 basis point cut last September, and interest rates did nothing but rise for 6.5 months straight. And that is partially because the Federal Reserve does not measure they don't control the mortgage rate, the rate at which banks will lend to people to buy homes, and they don't control the interest rate or the yield on a treasury at which people buy U.S. government debt. And you have a historic correlation of banks will look at the yield they can get in the treasury, typically 10 years, because that's based on how long people keep their mortgages, and the 30-year, which they will take effectively the yield of a 10-year treasury and add a spread, an interest rate spread above that, and that is how they make their money. So neither of those things are controlled by the Federal Reserve. So cutting rates does not necessarily solve affordability either for the United States government in paying its debt or for home buyers or home builders to make homes more affordable.
Well, I don't want to put words into your mouth, but I will put some words into your mouth to think about. I believe that this approach that the president has chosen is to pacify and satisfy his simplistic-minded followers, along with the American public, which only casually pays attention to personal and national finance. Your analysis is spot on, but because the Fed cuts rates and then interest rates don't go down and inflation goes up again, is that not a disturbing fact, especially to people who manage money for a living, that we have such a gross ignorance of how our system works and how free markets work? Not to mention, we haven't even gotten into the quality of the new homes being built, that we really have to sit there and find some way to innovate our way out of this. I mean, you and I have discussed this privately, and I personally believe that the lack of 2122 starter homes under $250,000-$200,000, depending on your geographical location, is a crime against home building. Would you not agree?
Yes, it's kind of a catch-22 though. In the home building world, you also have to have a product that people will willingly pay money for or borrow money to acquire. And one of the things that a lot of builders, especially over the last couple of years, have found is that that is a very difficult home to sell. Some of the home builders and communities, even from the big builders that have done the best, have been close to that, but they've been 3.2s and they've been under or around 13 to 1400 square feet. But it's not the post-war model, which could be built much cheaper basically everywhere. But there's not as much demand for that. And so part of that is it's not that builders aren't willing to go that route. I think they all, I know that they would all love to find ways to reduce costs right now. They're doing that. But you've also got to have a product that the majority of the population wants to buy. And so there's kind of a catch-22 for them between balancing what will people buy and how do they maintain some margin on it, and how close can they get to what people need and still not have losses. To that point, we've already got the first publicly traded home builder to post losses this year, and that is Beazer Homes. And that is not to be critical of them. That is just a reality. It's a very challenging environment for builders. It's a very challenging environment for home buyers. Part and parcel of what you're saying about an affordability crisis, the situation is becoming, is the right word, for the majority of the country right now. And again, cutting interest rates from the Federal Reserve doesn't solve that, at least not immediately, right? So raising interest rates, the entire point of that from the Federal Reserve is to slow the economy, right? And slow inflation, or the borrowing of dollars. But just like raising interest rates takes a long time to have any impact, lowering them takes a while as well. So even if they were to cut 50 to 100 basis points, that's not an automatic overnight solution. That's not going to suddenly unlock the capacity of the demand that exists, right? There's a lot of people that would gladly buy a new home, but in order to actually carry through that, you have to be willing and able to do so. So cutting interest rates is not a quick solution from the Federal Reserve, and it's not going to have the impact on housing that is commonly thought it would.
Well, I'm gonna jump in here, and before I go any further with Mr. Awsumb while he tries to reset his connection, the biggest thing that I'm seeing right now is you have a lot of elderly citizens in Florida, Texas, Arizona, et cetera, who retired in these homes, these mega homes, these 3.2, 4.2, 1,700, 2,100 square foot homes. And I'm getting ready to take over one myself, it looks like. And what has happened? They can't maintain them. They can't afford it, but they can't sell them because they're still paying a 3.5% mortgage, or it's paid off, but the availability of these smaller 2122 homes isn't there Now, we've seen some villas pop up like that in Florida. We've seen some of that in Arizona, et cetera. But the availability for senior-based homes is not there in the volume that's needed for them to transition out of their larger homes. Because why? Try selling a 2,100 square foot home in a premium neighborhood in Florida to a college graduate with a minimal household income of $70,000 a year. It's not that easy. And I think that's where we're going to run into a problem. Before I let Mr. Awsumb answer that, however, macroedge.net/ozone, macroedge.net/ozone. That is the place to go to read the latest articles, see some of our new contributors who have joined the team, and find out how MacroEdge is providing a cutting edge advantage, not just for your trading, but for protecting your assets. Mr. Awsumb, you back with us?
I am. Can you hear me okay?
Much better, sir. Much better. Sorry about that. I think the aliens were trying to kidnap him and send him off to the Federal Reserve prison where Mr. Trump is building it somewhere. So let's swing over from residential to commercial, because you and I have both been watching the various websites and announcements, how some areas of commercial real estate are doing great, but a lot of places, especially shopping malls, hotels, and now all of a sudden appearing on the radar, storage and CNI, running into a little bit of trouble for this great economy we have.
I'm sorry, John, but I've been informed that that's impossible. I'm kidding. Yes.
What? So I shouldn't bid on those. I shouldn't bid on those cheap properties, is what you're saying.
No, I think everybody should. That's the whole point of it, right? Yeah, delinquency's still increasing, and at least on collateralized loan obligations, there have been increased delinquency rates on loans for commercial real estate at regional banks, at the big banks, on mortgage-backed securities. And you're right, storage has recently joined them, including some fairly large-sized bankruptcies. So that's something new on the horizon to keep an eye out for.
Is this interest rate roulette going to do anything to help out the refinancing problem? Because when you see large declines in the actual asset valuations of these commercial properties, especially office, hotel, and retail, it's really hard to justify giving anybody asking for paper on that a decent rate because of the risk ratios.
Well, I would say it's part and parcel of the same thing, borrowing money for a home mortgage. Again, the Federal Reserve does not control the interest rates at which a bank or lending, we'll just call a lender, whether that is a syndicated fund, collateralized loan obligation, mortgage-backed security, what have you. The Federal Reserve does not control the interest rate at which that money is loaned to commercial real estate borrowers. It's basically targeting the interbank lending rate, and so over time, that lowers the rate at which banks lend to one another and winds up affecting the economy. But again, it's not an overnight solution. And for a lot of the commercial real estate that you have read about or that we've discussed at length that's having issues, they need something that's not that's a quicker solution to what they're facing. Because if you're behind 6 months, or it's the second time on a commercial property that you have become delinquent, the banks are actually beginning to foreclose. There's been a lot of foreclosure auctions of commercial real estate properties, so that has actually begun in earnest this last quarter. Taking 6 to 12 months for those interest rates to begin to trickle down to lenders where they can loan money at lower rates, you've got 6 to 12 months more stress. But if you've got a commercial real estate property that's maybe upside down $100,000 a month, another 6 to 12 months, you could be out another $1.2 million in money that potentially those operators don't have or don't want to lose. And so it would only accelerate their desire to hand back keys or allow foreclosure in lieu of spending more money on a property that they can't come out on. So it's a tough situation, especially given now that you've got some of these foreclosures going on, and you do have some savvy investors out there that are smelling some blood in the streets and making offers that people maybe would have sneezed at a while ago, and they're being considered because of some of the pressure that's on them.
So are you saying that there is a market finally developing for the B and C class commercial, or is it just simply a seller looking for a buyer of last resort to just wash their hands of it, get as much cash as they can, and make good as many private equity investors that they can? Because let's face reality, somebody buys a property for $100 million and sells it for 70% less. You're not making your partners whole, no matter how hard you try, and no matter how many cuts we get.
That's a pretty steep loss, yeah. But you're right, we have seen some very steep losses lately. And part of that is if there's lending involved, it's basically a forced action, right? So it's either take the loss now or go through the foreclosure. Anytime a bank has to foreclose on their property, they have to spend money in order to go through that process. There's legal fees, there's time. Time is money. So if they have to wait 3 to 6 months to actually complete a foreclosure process, they've got money that's not being repaid, and they're not paying back their investors or their depositors. And you've got tranches of commercial mortgage-backed securities that don't perform. So time is becoming more important in this equation. So it's all of the above. It's some buyers are willing to take whatever they can to get out of the situation to prevent further losses, and there's beginning to develop in certain markets price discovery where, to your point, even some of these properties are trading at 25 to 35 cents on the dollar just to get a transaction to free up whoever's in that property now, and it's not going to make their investors or themselves whole on it.
All right, I'm going to ask you one final question because I want to bring Six up here in a few minutes to talk about the markets, and I really want to get your opinion on this. A lot of people weren't around like me. I'm admitting to the listeners of MacroEdge Radio, I might be a day or two older than a lot of you. But I was in high school and college in the late 70s, early 80s, and I lived through the stagflation of Arthur Burns and initially Paul Volcker. This economy is not structured with the level of debt that it has for a stagflationary outcome. Do you have any thoughts about what stagflation for a prolonged period of time, 1 to 2 years is my guess, would have on commercial real estate and then residential real estate?
That's a great question, because I think that of the things that we're witnessing that are stagflationary, certainly commercial real estate might be the one thing in most areas that has been or is immune to that based on how investors invest in it. With rates being what they are, with the mindset already taking place of investors saying underwrite with less risk tolerance in mind. So you already have a fundamental shift in the way that investors are viewing commercial real estate, rather than the concept of it just rents will always go up, values will always go up. And then same with housing, especially for new builders. They have been lowering prices for 2 years. They're lowering prices faster this year, and they're spending more money to get people to buy. So those are two areas where there isn't necessarily stagflation going on. And I'm not sure that we could even get to that point because of the stretched affordability of both. And there's going to be certain segments, and I think even in the stagflation environment you described, there were certain things people didn't buy because of the cost of them. And so you wound up having a time period where the price of several things went up incredibly through the 1975 recession up into the 1979, 1980 end of the next. But you wound up seeing it come out in the 1980 to 1983 cycle in those two recessions where the cost of automobiles crashed. You had auto manufacturers were facing bankruptcy. We had a Chrysler bailout in 1981. So there is potential for stagflation in a lot of areas of the economy. But the big ticket items where people have to borrow money because it's the only way that the American public at large can acquire those things are already facing the opposite of stagflation, which is price impairment. And I won't call it deflation simply because to see deflation across the economic cycle, we're talking about the destruction of money, and I don't think we're there yet. But you have those factors at play, those risks. So we might see stagflationary prices for a lot of everyday goods, but those big ticket items, I just don't see. I don't see unless there's a way that somehow everybody begins to make much more money on average for the typical U.S. household, where those items can continue to increase any further quickly the way that other things have.
Well, I'm going to put a bug in your ear for a future article from yourself because we have a great guest in our room tonight, CH at Economica. If you're not following him, that's at ECONIMICA. Puts out some fantastic charts. Great follow, by the way, folks, if you're on X. And
I have to agree with that.
There's a demographic time bomb, which just happens to coincide with residential real estate, big ticket purchases, and a stagflationary environment. And if you start to overlay those, I can't wait to see your theoretical outcome of what would happen if all three of those intersections occur in the next 12 to 24 months. Because realistically, I think we're there.
I'm going to throw a caveat onto that.
And he goes into the aliens have absconded with Ulysses Awsumb. Everyone, Ulysses Awsumb, part of the MacroEdge team. Can you hear me? I don't think you can hear me.
Loud and clear. Can you hear me?
Now you're back. Go ahead, sir. Sorry about that.
It's okay. I just wanted to throw a caveat to that, which is near term, right? I think that we are probably approaching a recessionary period, if not already there in the United States. And once some of this excess in commercial real estate and some of these automobiles, we see some more price impairment to the point where people can actually afford those things again. Depending on what the government does in response to more of that, then we could see more prices rise again. But I think we'd basically be through recession at that point and starting a new business cycle. So just to add that.
Thank you so much, sir. And I am going to bring the Grand Master, the guru of MacroEdge, 6. Welcome to the casino.
Hey, John, that's a hell of an introduction. Thanks, buddy.
Well, I mean, you see the reaction of Wall Street today. You see the videos. You hear the news about sports gambling on Wall Street. You see a stock that is a Chapter 11 trading 299 million shares. I don't know if you heard that part of the show.
Is that Open Door, I'm guessing?
No, Motive
Okay.
Care, MODIV Care filed. It's a $10 billion. It's actually about $8 billion bankruptcy out of Texas, boys and girls.
Oh.
And they filed bankruptcy the other night. Today was the last day of trading. We didn't know that at the time. I didn't participate, by the way. And it was up 91% to $1.07. And then they were delisted after the close.
That sounds about right for what's going on right now. Yeah, it's an interesting period.
So to steal the MacroEdge expression, we're in the cycle, sir. And what do you make of everything we witnessed today? I've got to hear your take on this.
So this strikes me very similarly to what we saw in around September of last year. I'm hesitant to have this, but I can see the case for this being very similar in the fact that, we had a period of soft data, then bonds rallied, the Fed cut 50, and then bonds immediately sold off in a huge way. And I can see the case for that to happen again and for this period of soft data to smooth over. But also now we have these tariffs that I do have more concern overall about the economy, but it's really hard. We're at such a crossroads because like you have growth that is slowing, you have inflation that is picking up, and you have to be able to say, is this inflation actually going to be transitory? Is the Fed going to be allowed to get bullied into agreeing with Trump? And today it looks like I'm not sure if the data was weak enough that that's actually, what he was doing, or if he kind of is like bending the knee to Trump. And I guess we'll see over time. I have the urge to short bonds right now, but I am pretty nervous in taking that trade because the growth picture is weakening. It's definitely softening. Jobs are pretty weak right now. I think we're at like 35,000 average jobs, which should be below the replacement rate. Like that's some recessionary prints. But the speculation is just so high, and I mean, I'm still long a lot of stocks, to be honest, but I'm not long tech. I'm trying to stay out of the high beta stuff. I'm trying to buy stuff that's cheap, maybe that I think has troughed for multiple different reasons. But I mean, it's a pretty dangerous period for risk, honestly. The presser could be interpreted as pretty hawkish in the sense that the economy is it's pretty weak.
Well, I'm not gonna brag. I'm not gonna name names. I'm not gonna sit to promote my book. But when I have crap juniors that are just now starting into production, gaining 10, 11, and 14% per day on wild swings like this, I want to thank Mr. Powell and Mr. Trump, and please keep pumping it, because the more gold goes up, the more silver goes up, the happier I can retire. But that's also got a consequence, which indicates that risk is being hedged on the sidelines. But we don't see a lot of hedging from this younger generation. Is this a new thing where we're just going to bet on our zero DT options? We're just going to bet that whatever is hot, the coin, the crap coin, the shit coin, whatever, and damn it, if the consequences happen, I'll get bailed out by the government.
I saw a pretty good post from that younger guy, Zoomer, today, and he articulated it pretty well. The younger generation kind of is absolutely getting screwed by housing prices, by inflation, and they've seen over and over again that buying stocks, you always get bailed out through one mechanism or another. They always go back up, and they've kind of been forced out the risk curve if they want to. I mean, you think about a young person and what do they have? They don't have much to lose, so they have asymmetric upside in taking on excess risk. And it looks like that's what they're doing in absolute droves. Is it stupid? Yes. Will it work? It has so far. Will it continue to work? I don't know. But that's where we are. And, I'd be lying if I said I didn't have a few of those kinds of things in my book at the moment.
We all have one lottery ticket in our book. Let's be honest.
Yeah.
But I've really got to ask, do you find it crazy that people aren't hedging on the idea that short-term interest rates, the 1 through 3, maybe 6-month part of the curve, could actually accelerate higher due to the political instability that we are experiencing domestically, the attacks on the Fed, the craziness in DC, a potential government shutdown, et cetera, and of course the tariff wars, because we're all paying 50% more for our butter knives from India. There's a lot of risk in the near term that's not hedged, and that scares the crap out of me.
I mean, I do agree with that, but not so much because I'm 25 times levered long the 2-year note right now. So I mean, that kind of tells you where my head's at, I guess, better than I could.
Well, no, no, I'm not saying the 2-year. I'm saying the very short term. I think you're spot on. I don't think they're going to let the belly of the curve, 2s through 10s, do anything. They're going to make price appreciation happen there. If by God, Bissett and whoever's in charge of the Fed next has to buy the bonds. I just think that we're just going to issue so much short-term paper, it's going to balloon the short end of the curve.
Yeah, that could happen. I mean, we haven't seen it yet. You see it. I mean, you've highlighted this. You see it in Japan and in the Asian session. You'll get big spikes in yield overnight, and during a liquid trading, sure, but yeah, I mean, you are seeing some signs of that. I haven't really done a proper investigation of the causes of that, so I'm not sure how serious that is or how much of an indicator that really is, but yeah, we are seeing some signs of that. To your point.
Well, the reason I bring that up, okay, it's Norinskin and a few insurers and some other banks over in Japan, from what Just Dario and others have done with their investigation, including Juken Kalashi. But the thing that we're seeing in that is that they're trying to raise dollars to cover and pay off dollar-denominated debt and get it off their books. And that's logical. You sell you sell bills. You have two buyers. J.P. Morgan admitted they've purchased over $400 billion. You've got grandpa investor Warren Buffett hoarding tens of billions of T-bills for a cash haul, preparing for something, either Armageddon or he's going to buy every company on the S&P 500 worth a damn. There is the potential of a liquidity crunch for dollars until the Fed gets a coherent policy together, in my opinion. And I think we have a risk in the next 60 to 90 days of a liquidity squeeze that the markets just don't see. It's a blind side.
Yeah, I mean, I'm not sure I'd really be the guy to ask about that, but yeah, but, you know,
The blind
the
side part.
yeah, that's interesting. I mean, kind of. I think today most people's portfolio appreciated nicely today. I think today was a good day. But yeah, I mean, I have some hedges. I probably will buy some more hedges. I did cut a little bit of risk today. I probably will investigate buying more volatility. Yeah, I mean, when things on the book that I manage of other money, we're getting out of tech right now, so that's where my head's at.
Hey, John.
What do you make?
That's a good question.
Go ahead, Mr. Awesome.
6, can you envision a scenario where over the next few months there's a need for what's termed high quality collateral that would bring yields, even on longer term bonds, down further?
Yeah, I could. If this tariff stuff actually does pick up, and I'm not sure that this, like, we still have these tariffs and everybody's kind of just forgotten about them now, but they are of substantial size and they're not evenly distributed in the economy. So, I mean, they're talking about, they think that the tariff revenue by the end of the year is going to be well in excess of 300 billion, and that creates an unequal distribution of who's paying these tariffs, who's getting hit by them. They are going. It sounds like more companies. They haven't totally passed them on to the consumer yet, but every indication we've seen from these big companies indicates that they're planning on starting to pass them through to the consumer. So it sounds like that situation is going to get worse, not better. But on the same hand, we have the federal government just running very large deficits, financing present growth from with debt, and it's hard to know what level of negative stimulus you would need to cancel that out. But of course, I mean, obviously, it all happens on the margins, and yes, I do think that there could be a squeeze towards higher quality collateral, and more buying of debt at the first sign of any kind of disinflationary or deflationary impulse from these tariffs, which are transitorily inflationary, but they're also negative to growth, and growth is clearly going to take the front row seat in eyes of the Fed and eyes of the market. So, if it does continue to hit growth, and growth's been weak the last 2 quarters. So, I mean, if that continues, then yeah, it's probably going to cause more ripple effects, and then you'd probably see something like that, I think.
Oh, I'm going to throw a monkey wrench at everybody's economic thinking. First of all, there's an anniversary coming up on September 3rd. Do you know what that anniversary is?
No.
See, that's why Sticks loves me, because I'm the history geek and remember these dates like it's right off the top of my head, and they're the stupidest dates in the world. But that was the all-time high for the Dow Jones Industrial Average in 1929. Would be coincidental if we hit it again, wouldn't it? But on a more serious note, and this is something to think about. I want you to think about this. You're talking about the deflationary impacts. I just highlighted the transportation slowdown on inbound freight to the United States.
Yep.
Rails were down last week, but that's a seasonal thing. I'm not going to sit there and just dismiss that out of hand or take that as serious data until it becomes a trend. But what happens when the new head of the BLS creates a new, more politically favorable calculation for employment, further distorting the data that's already there? What do you believe? Do you take the inflation data as primary, or do you believe the employment data? That's what blew me away about Powell's speech today. He took the employment data at face value without reevaluating what happens when the new system is imposed.
Yeah, that's a really tough one. You're going to have to take all the BLS reports with a hefty grain of salt going forward. And I think you're just going to have to look, you're going to have to underweight that component and then overweight other components. Maybe like ADP will probably be watched a little bit closer than it usually is going forward. And then just all of the other different economic factors. But yeah, I mean, it's going to be tough because the jobs reports are going to be much harder to read now. It's going to be tricky.
Six. Close us out. Head us into the close. Tell us what's going on with your work with MacroEdge real quick. There's a lot of exciting things coming up. Fill in our listeners so they know what we're up to as a team.
Yeah, so we've got a lot of different things going on right now. We got the Resites division with Mr. Awsumb, who just spoke. They're doing a really good real estate research. We're working on a couple other things that we're not quite ready to share yet, but they're coming soon, and I'm very excited about them. And then we've got our Ozone stack of economic research. We've got Alpha One, which is coming soon. That'll be our institutional offering for macro and positioning data for any of our listeners that might be fund managers, wealth managers, asset managers of any kind.
Fantastic, sir. I appreciate it. Thanks for hopping on real quick. And remember, folks, just because the history buff sits there and throws a date out does not mean it's going to happen again. But a lot of times it rhymes, and it can get pretty damn scary. For MacroEdge.net/Ozone for your 2-week free trial, MacroEdge.net/Ozone for your 2-week free trial. Not sure if we're going to do a show next Friday night. It is a holiday weekend, and yours truly might be on vacation. Yes, I know. I take a lot of vacation because I can take a lot of vacation. For MacroEdge, this is John Galt. Good night now.